Thinking about retiring in the great state of Massachusetts, are you? Well, you've come to the right place because we're going to examine how Massachusetts taxes retirees. Welcome again, my friends, to another edition of the Heritage Wealth Planning YouTube channel, the place where we tell you how Massachusetts taxes retirees and retirement, as well as the other 49 states on top of it. So let's dive right into it and see how the great state of Massachusetts is when it comes to retirees. And as we start, we always start with the Kiplingers. And we'll go up that little tiny state in the light blue, which is not tax friendly. So if you have five different, you got 50 states. What's it? Not a quintile, but I guess it is a quintile, isn't it? Yeah. So you got 5 quintiles. So Massachusetts would be in the 10 to 20 quintile, the second lowest quintile or second highest tax burden quintile is probably a better way to look at that. But they're not nearly as bad as neighboring Vermont or their New England neighbor to the south, Connecticut. But they're not nearly as good as New Hampshire, of course, or Maine either. So the states in Rhode Island is similar to Massachusetts. So in the 6 New England states, Connecticut, Vermont, get the dark blue, least tax friendly. Mass, Rhode Island are not tax friendly. New Hampshire is most tax friendly, and then Maine is mixed. So there you go. All right, so let's see what the great Kiplinger's website says about Massachusetts being friendly relative to taxes for retirees. And we'll start there. We'll click on that guy right there, my friends. Not tax friendly. The Bay State offers a couple breaks to retirees. Massachusetts does not tax Social Security, so that's good. And they don't tax most government employee pension income either. But all other income is taxed at a flat rate of 5.15%. Property taxes run high, although there is a refundable tax credit available to eligible homeowners 65 and older. And Massachusetts also has its own estate tax, which is actually quite painful to bear. In fact, I think it's now the worst in the nation now that New Jersey got rid of their own estate tax. We'll talk about that in other episodes, but anyway, that's not good. It's bad actually. Massachusetts has a state sales tax of 6.25%, and most clothing and footwear priced under $175 are exempt. All right. Income tax range. We talked about the flat rate of 5.1 on federal adjusted gross income. So remember the difference between the gross income and taxable income. They're doing on adjusted gross. So that's too bad because taxable income is after deductions and whatnot. So they're saying you have $100,000 of AGI, federal adjusted gross income. They're taxing at 5.1% on that. That means they're taxing at $5,100, where I'd much rather have them say, we're only going to tax you at 5.1% on your taxable income, which would be after standard deductions. So that's pretty bad, actually, right there. That's not good. We'd much rather have them taxed at your taxable income as opposed to AGI. Again, AGI is before deductions, all right? So, geez Louise, before your mortgage interest deduction, before your state tax deduction, your state property tax deduction, charitable deductions, all that. You make $100,000, they're taxing you 5.1% on that. And then if you only have taxable income of $50,000 because you have $50,000 of deductions, doesn't matter. They're taxing you at 5.1%. So when you think about it, if you had $100,000 of gross income to the feds, you're paying roughly $5,000 to the state of Massachusetts, Commonwealth of Massachusetts. If that $100,000 of AGI was actually the same as $50,000 of taxable income because you have all these various deductions in there, you're paying not a 5% tax rate, you're paying a 10% tax rate to the state of Massachusetts because you're paying $5,000 in taxes on $50,000 of taxable income. That's pretty significant. State legislatures are debating a constitutional amendment that would create a 4% surtax on all income above $1 million. A final decision might not be made until 2018. So there you go. Social Security benefits are not taxed. Civil service and state pensions are exempt. Also exempt pension income from other governments that don't tax Massachusetts government income. So that's a nice gig if you can get it. So if you work for the government there in Massachusetts, you decide to relocate to, let's say, Oklahoma, and Oklahoma has a reciprocal issue that they don't tax public pensions. You don't have to pay taxes on your Oklahoma pension if you lived in Oklahoma and have a pension there, or vice versa. So that's great. But what if it's for a private entity? Doesn't matter. All right, so IRAs tax at ordinary income, no exemptions for any other deferred accounts. Private pensions are taxed at ordinary income as well. No wonder why New Hampshire looks a lot more favorable for sure. Property taxes, Massachusetts does not have a general homestead exemption either, but it does have a Homestead Act, which permits a homeowner who occupies a house as his principal residence to shield up to $500,000 in equity from creditors. All right, well, that doesn't help from taxes. The median property tax on Massachusetts home is about 1%. So the median property value in Massachusetts is roughly $400,000, and the median tax about $400,000 is $40,000. So that's 1% property tax on top of no exemptions for IRA, 401k, private pensions, and on top of that, a flat rate of 5.1 on AGI. That's not good. That's actually quite painful. If you have a pension from a state or local government, it's tax-free, but it actually doesn't say if it's tax exempt from the federal government pension. So very favorable for a state and local government employee, that's for sure, which seems not fair to me, but be it as it may, you can always leave the state if you're not happy there. Let's see what they offer for seniors specifically. Homeowners and renters who are 65 or older may qualify to claim a refundable tax credit on their state income taxes to offset real estate taxes paid during the year. For 2015, the taxpayer's total income cannot exceed $57,000 for a single filer or $85,000 for married filing jointly. For homeowners, the value of the residence cannot exceed $693,000. The maximum credit was $1,000. So that's pretty good. Think about that. If your income, you're married filing jointly, and you have income below $85,000, and your house is below $693,000, the maximum credit you could get is $1,000. And again, a credit is much better than deduction because that's 25% of this right here. All right. So if you had a $4,000 property tax and your house was on the average value of $388,000, and you could qualify for that max credit, you just had a 25% reduction in your property tax. That's pretty favorable. Now, that said, that's a maximum credit. I don't know if it phases out as you get more and more income, getting closer and closer to the $85,000 threshold. I don't know. And it says total income, so I presume that's AGI as well. And so, again, it was too bad. We'd much rather have his taxable income over than AGI. Some Massachusetts cities and towns offer a senior citizen property tax work-off program, which allows seniors to do volunteer work for the local governments in exchange for reduction of property taxes. All right, well, that sounds like a pain, but hey, more power to them. At least they give you something. And I actually like those kind of programs in a way. A lot of talent among senior citizens, the old people, lots of talent, lots of brain power there. We'd like for them to put it to use as opposed to just sitting around watching Jeopardy all day long. So I got no problem with that at all. They can certainly do stuff at the local library or whatnot and help out, save the taxpayer dime for not having to pay a body to work there with full benefits and everything. And yet at the same time, use their brain power to help the community. I got no problem with that whatsoever. Sales taxes due. They levy an annual excise tax on vehicles. The rate is $25 per thousand of assessed value. They say an example, a 3-year-old car that's sold is on MSRP as well. Okay, so the 3-year-old car that's sold for $30,000 would have a tax bill of $300. All right, so that's that's not cheap either. That's for sure. Now, this is the big one for me: is inheritance and estate taxes. Estates valued at more than $1 million are subject to estate tax. And remember, estate is everything you own when you die. Life insurance is in your estate, my friends. Life insurance, property, 401ks, IRAs, all that is in your estate. If you own it, it's in there. And by the way, once you break the $1 million threshold, it all goes back to the very first dollar as well. I was reading some attorney's blog not too long ago, and there's a terminology they use for that. I forgot what it's called. But it's not just the first $1 million excluded. It's once you break that, it's all included in your estate tax to the great state of Massachusetts. There's an unlimited marital deduction for property left to a surviving spouse. So again, if I leave my money to my wife, she doesn't pay any estate tax, but at her death, the estate certainly will. And there's no inheritance tax. So that's all bad across the board. The only good thing here was the 25%. If you're a government employee, that's pretty good. And then the 25% reduction on property taxes, a credit on property tax if your income is low enough to qualify and your property value is as well. All right, so let's now go to and see what they say here, the Tax Foundation. All right, so taxfoundation.org, and we're going to start with individual taxes. We already talked about 5.1% as a top individual income tax rate, and state and local tax burden is 10.3, which ranks Massachusetts in the top 12. And we don't want to be in the top 12. We don't want to be in the top 20, but at least it's not the top 10. And then Tax Freedom Day is May 5th, which ranks them third from last. Sales tax. Sales tax is 6.25%, which is actually pretty good. I know that looks like, oh my goodness, sales tax 6.25% all in, but the state and localities do not have an extra sales tax on top of that. So sales tax is actually pretty good. Again, you got to look beyond just the top line, because when you factor in the locals, they don't have that. So sales tax goes from 13 from a state to 35 when you factor in everybody, and that's pretty good. Of course, their friendly neighbor to the north of New Hampshire has no sales tax. So if you live in Newburyport, you'd be crazy not to just bump up there and go to New Hampshire, buy all your goods. In fact, if you look in the parking lots of the various shopping malls in New Hampshire, a lot of Massachusetts tags there. Gasoline tax, pretty low, 26.4, and I had a feeling the cigarette tax would be quite high. So if you smoke in Massachusetts, you're probably going to want to go elsewhere to get your smokes. Property tax we talked about is pretty high. Yeah, it ranks 18 for the overall percentage and 8 in terms of total dollar amount. But from a percentage, it's in the top 20, but it's on the low end of the top 20, more towards the middle of the U.S. So that's not so bad. I mean, it's not great. Don't get me wrong, but it's not as bad. Now, from a pure dollar perspective, it's bad simply because Massachusetts homes are more valuable than they are in like Alabama. So you're going to pay more from a pure dollar perspective in Massachusetts than you would in other states. Let's go to Smart Asset. Great state of Massachusetts. And now, again, this is just for income tax, my friends, just for income tax. Massachusetts fully exempts Social Security while taxing most other forms of retirement income. The state tax, we already talked about that. The calculator reflects the changes in the 2018 Trump tax plan. So what we do here is we say $25,000 of Social Security, and we're going to say $25,000 of IRA distributions or 401k distributions, if you will. We're going to say you're born in 1953 to put you at 65 so you can qualify for any senior citizen discount. And we're going to say you are married filing. What will happen here? We're going to say you're married filing jointly as well. All right, so let's make sure you don't have a pension on there. No. All right, so we have $50,000 income in Massachusetts. We pay $817 to the state, which would 817 divided by 50,000. That's a 1.6% tax rate. So that's not so bad. So let's do this instead, though. Let's do 50,000 Social Security. Boink. Boink, and nothing on retirement accounts. And the reason I say that is because say you took out your retirement accounts before you drew Social Security to allow your Social Security to get the delayed earnings credits, and look at that, you pay nothing. Just something to think about. Let's say you have 50,000, nothing in Social Security, and 50,000 of retirement accounts. I bet your stack's much higher, and it is. It's there you go. There's your 4% right there. So the strategy there is, if you're going to live in Massachusetts, we want to max our Social Security and reduce our retirement account income without question. Without question, we want to do that. All right, so I'm just curious here, just while we're doing this, what if we have a $50,000 from public pension, and I'm going to presume it's nothing for taxes, and it's nothing. What if we have $50,000 from a private pension? I'm going to assume it's the same, about $2,000 in taxes, and let's see, yeah, $2,000. So $2,000. There you go. So again, Massachusetts, very favorable to government pensioners and very favorable Social Security, not favorable to any other sources of income, and you don't get any exclusions. So all in all, Massachusetts is pretty painful. If I was going to retire in Massachusetts, I'd be looking at ways to maximize my Social Security and reduce my IRAs. Absolutely. Absolutely. And what I would actually be doing is I'd be 1.5% flat rate now while I'm working. Because think about it, if I'm making pretty good money now and I can pay 5.15 to Massachusetts while I'm working and have maybe some excess cash flow, or I have enough income coming in because I'm working, and I can avoid paying 5.15 in the future when I'm retired and I have no other income coming in, that's probably a trade worth making. So that you got to really start looking at Roth IRAs, Roth conversions and whatnot. Really need to focus on delaying taking Social Security as long as you possibly can, because Social Security is completely tax-free. $70,000 of Social Security, and people are, I can't get that. Yeah, you can. Absolutely. If you wait till you're 70, you certainly can. $70,000 of Social Security is taxed, not a penny to Massachusetts, where $70,000 of IRA distributions is taxed pretty significantly. So we'd much rather have you get Social Security benefits than any other source of benefits in Massachusetts for income. And the facts are the sales tax is not crazy there. So if we can get your income reduced, your taxable income reduced, your property tax, it's going to be, it's not extraordinary. It's high from a dollar perspective, but it's not extraordinary. It's reasonable for sure. And then your sales tax isn't extraordinary too. It's your income's a big one. And then the estate tax is bad. But if we can get your income to be taxed more efficiently, you're going to be not a bad place in Massachusetts. You're just not. It's just a matter of where your income comes from when you hit retirement. And that's where Social Security can play a huge role. Hope this helps, my friends. As always, don't forget to thumbs up. Thumbs up are hugely helpful to me. Don't forget to subscribe and then hit the little notification bell down there to subscribe right there on the bottom right-hand side. It's a tiny little thing. It says click here to subscribe. And then there'll be a red button as well that says subscribe. And then comments are always welcome. Love to hear what you say. And we'll see you now. Oh, and then go to the blog, heritagewealthplanning.com. I got my podcast there. I got my blog post. Lots of stuff on the heritagewealthplanning.com. And then we'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.